All right, welcome to another session of the My Solo 401k Financial Daily Webinar Series. If you have questions or topics you wish to discuss, please chat those over now so that we can be sure to get to them all. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney. So this is another session from my solo 401k. We have these daily live webinars. So these are Q&A sessions. This is your chance to get answers. So again, please chat over the questions now if you have questions or topics you wish to discuss. We do have some prepared content for us, so we want to make sure to get to that as well. Today's topic is 1231 Cutoff. How new and existing solo 401k owners can start claiming $1,500 in tax credits, starting with the 2025 tax return. So we'll break it down, how to qualify for the tax credits. We'll talk about the December 31st deadline, because that's always a hot topic this time of year. So we like to use this as a way to, again, answer questions, go over content. Ultimately, our goal is to help you stop overpaying taxes and start building real retirement wealth. All right, with that, let's get into the slides. So the Secure Act, Congress created a number of tax credits to address the perceived 401k, or I should say retirement savings crisis. And their vision, or at least one tool to help address that, is to encourage businesses to either set up or expand 401k access. And so one of the tax credits that was authorized by Congress is available to those who establish a solo 401k plan with an auto enrollment feature. In my solo 401k, we are the leaders in the industry on a number of fronts, including these tax credits. We were the first solo 401k provider to offer a plan that was eligible for tax credits. We worked with the IRS legal staff and other industry stakeholders before we rolled it out at the end of 2023. We waited until the IRS updated the form that's used to claim the credits. And now you're seeing other providers starting to offer plans, but much more recently. We did this over 2 years ago. You see others starting to do it maybe in the last couple of weeks. So that's just another example of how my solo 401k Financial is a leader in the space. For example, we were the first provider to offer a plan that was eligible for or that would support the mega backdoor Roth dating back to 2013. We've had customers that have been using it since then, and now they have over $1 million in their Roth account. So again, you've come to the right place if you want to learn about solo 401ks. And so now that we've established our authority, let's dig into how you could either open a new plan to start claiming $1,500 in tax credits, or even upgrading an existing plan. So if you want to open a new plan, first of all, you got to be eligible. So you would be eligible if you're self-employed with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any. That is what gets you in the game. That's what makes you eligible. Now, in order to be eligible for the tax credits, you also would need to have a plan that includes an auto enrollment feature. So we automatically draft our plan documents to include the auto enrollment feature, the other required notices that are needed to make the self-employed business or solopreneur eligible to claim these $1,500 in tax credits. So the tax credits are $500 per year for 3 consecutive years. So if someone sets up a new plan in 2025, which we established the plan within the same business day when you sign up, so there's still time to do it in 2025. they would be eligible to claim a $500 credit on their 2025 tax return, and then again for 2 more years, as long as they maintain that plan with the auto enrollment feature. Now, part of that auto enrollment feature is going to establish a default 3% contribution percentage. But the solo 401k participant has a right to opt out of the default contribution percentage and still be eligible to claim the credit. Because in order to claim the credit, the business just has to establish a plan that includes the auto enrollment feature. Just because the participant exercised their right to opt out of the default doesn't mean that the business didn't have a plan that includes the feature. Of course, it still did. Opting out of the default contribution percentage simply means that the solopreneur can contribute more, could contribute less. So that individual is now is going to be able to contribute as much as they want under whatever schedule they want, of course, subject to the contribution limits and the deadlines, without being tied down to that default contribution percentage. Now, these credits are not just available to new solo 401k plans, but also to existing plans that are upgraded to include the auto enrollment feature and the required notices, etc. So that means that this is just another reason that someone that has a basic solo 401k plan at a discount brokerage, like say Fidelity or Schwab or Vanguard, Ascensus, E-Trade, down the line, this would just be another reason to upgrade to our plan. Because historically, we've always had a large percentage of clients who started out with the basic plan somewhere else, and now they want to upgrade to our plan to take advantage of the service and features, and now the tax credits. So, for example, some of the features that would cause someone to want to upgrade would include the ability to make mega backdoor Roth, the ability to do in-plan Roth conversions, the ability to take a 401k loan, the ability to invest in alternative investments like crypto, like real estate, as well as the service. So we specialize in supporting solo 401k plans. So that's going to be, for example, educating customers on how much they can contribute, so the contribution rules, educating customers on investing in alternative investments and the mechanics of doing that, preparing the required loan documents for those that want to take a 401k loan, as well as the important compliance requirements. Because, for example, once the value of the solo 401k plan, including the value of any defined benefit plan that the self-employed person might have as well, once the value exceeds $250,000, there is an informational filing requirement called a Form 5500EZ, and the potential penalties for failing to file that are high. They're $250 per day. So we prepare that 5500EZ for clients, and we do that for no additional charge. Now, they have to just let us know once the value exceeds $250,000, because we don't have access to their accounts. We don't provide customer accounts. We're not managing their investments. We are the plan provider. Now, we're very hands-on in helping customers open up the accounts at the bank or brokerage of choice, and we're super compatible. We're portable. In other words, customers get the plan documents from us and then open up the accounts at the bank or brokerage of choice. But that also means we don't have access to those accounts. So they got to let us know once the value exceeds $250,000, so we can add their plan to the queue and take them through that 5500EZ filing process, where the 5500EZ, we end up filing it through the electronic filing system to make it easy for the customer. So that would be reasons why customers already want to upgrade to our plan. But now the tax credits just make it even more attractive, because these tax credits are going to more than cover our fees for the first 7 years. We charge $650 as an initial fee. That includes the $525 establishment fee, plus the first $125 annual fee. Then starting 12 months later, we charge our $125 annual fee that covers the second year. So if you have a basic plan at Fidelity, at E-Trade, at Schwab, Vanguard, Ascensus, down the line, all you need to do is sign up with us by the end of the year, because we will then prepare the restated, the upgraded solo 401k documents within the same business day. Then you can take your time to open up the new accounts. So as part of that restatement process, new accounts will need to be created for the restated plan, which can be at Fidelity, they can be at Schwab, they can be at E-Trade, etc. But you still need to have the new accounts, because those existing accounts that you have, those pertain to your pre-existing solo 401k plan documents. So for example, if you have a basic plan at Fidelity, that means you have the documents from Fidelity, which are limited, which don't support the advanced features, which don't allow for the tax credits. And of course, you have your accounts at Fidelity. But Fidelity will open up accounts for people that bring their own plan documents. So if you restate, that means now you're upgrading the documents to our documents. Now you'll need new accounts that are governed by those restated plan documents. Now, in order to be able to start claiming the credits on your 2025 tax return, you don't need to open up the new accounts by the end of the year. You just need to update the documents by the end of the year, which we make it easy to do that because we prepare those updated documents within the same business day when you sign up. All right, so now let's go to some of the questions that are being chatted up. Thank you for bringing the questions. From Cindy, hi and thank you. I just applied for my first solo 401k with Fidelity. However, I now understand this is not self-directed. Is there time to add your self-directed solo 401k to the one I just submitted for yesterday? That's a great question, Cindy, and you've come to the right place because that's exactly what we're talking about. So yes, as we went through, there's still time, and that's a common use case because individuals do want to have the ability to self-direct their solo 401k, which they can't do with the basic plan at Fidelity, but you could update, you could upgrade, you could what they call restate your Fidelity plan to our plan, which you would simply do by signing up on our website. And it's the same application, whether it's a new plan or upgraded plan, a restated plan. One of the questions will ask if you have an existing solo 401k. So you'll say yes, solo 401k at Fidelity. You'll enter the original effective date, which will be January 1st of 2025 if you signed up, if you established that plan here in 2025 and you didn't already have a solo 401k plan somewhere else. So you'll enter January 1st, 2025, submit the rest of the information on the application. It's just 10 simple questions. It's straightforward information, such as your name, the name of your business, how your business is taxed, etc. You'll choose the name for the plan, which is just going to be 2 words in the word trust for a total of 3 words. Make the payment. We'll prepare the restated plan documents within the same business day. Then you can take your time to open up new accounts at Fidelity or somewhere else for the restated plan. Now those accounts will be governed by our plan documents, which means you'll have access to the advanced features like the ability to self-direct your solo 401k, the ability to claim these tax credits. Great question, Cindy. Thank you for bringing it. All right. So next question is from Jim. So the ability to invest in real estate, the ability to take a 401k loan, that's some of the top features of our plan. Now, this is the busiest time of year. So the calendar is booked out for the rest of the year, but feel free to book a call at your convenience in January. If you already have an existing solo 401k plan, there's no rush to update the plan by the end of the year, for example, from a contribution perspective, since your plan already exists. So you can take your time and we can talk through your situation. Next question is from Sachin. I have a SEP IRA at Interactive Brokers where I made contributions in 2024. For 2025, I'm thinking of a solo 401k as I have lower income and can use employee and employer. Do I need to mention about the SEP IRA to open a new solo 401k with you? Any implications of that? That's a common scenario, Sachin. You do not have to mention on the application. Now, if you want to roll it over, we like to capture that information up front. You don't have to tell us though. I mean, you could always choose to roll it over later. So as far as the implications, it's fine. You can certainly have a SEP IRA and a solo 401k. Now, there's no reason to contribute to the SEP IRA once you have the solo 401k, because any contributions that you make to the SEP IRA would just reduce what you can contribute to a solo 401k. A solo 401k has tremendous advantages over a SEP IRA. One of them you already touched on, right? The ability to not only make employer contributions, which you have with the SEP, but also the ability to make employee. And that means you're going to be able to more quickly meet your contribution goals. So as you mentioned, when you have lower income, the solo 401k becomes more attractive. Really, it becomes more attractive regardless of your income. But when you have that lower income, you can contribute 100% of your self-employment compensation as an employee contribution, dollar for dollar, up to $23,500 for 2025 or more if you're age 50 or older. And then if you still have additional income and capacity to make contributions, then on top of that, you can make an employer contribution. And then you could also even make additional contributions if you got the self-employment income to justify it as voluntary after-tax contributions. That's another advantage of the solo 401k. The making voluntary after-tax contributions is how one makes mega backdoor Roth contributions, where that gives individuals the potential to contribute up to $70,000 for 2025, where the funds end up in a Roth account. That's 10 times how much you can contribute to a Roth IRA. So that's a huge advantage. Other advantages, the tax credits. So these solo 401k tax credits, the $1,500 in tax credits, they're just simply not available to a SEP IRA. But of course, they are available if you set up a solo 401k plan like the one that's offered by my solo 401k Financial that includes the auto enrollment feature. Additional benefits are going to be the ability to take a 401k loan, the ability to easily invest in alternative investments. Again, assuming you set up a fully featured solo 401k plan like the one offered by my solo 401k Financial. Yes, thank you so much, Jim. I would encourage you to go to either email us at business@mysolo401k.net, or you can also go to our calendar, mysolo401k.net/book. Thank you so much, Jim. We look forward to digging into your situation. Next question is from Carl. If I make 2025 contributions next year, but before my return due date plus extension, how does my payroll company update my 2025 W-2? Well, that's a good question. It's a common question. And so in short, what customers do is they just let the payroll company know, or whoever's going to be issuing the W-2, the employee contribution that they're going to make, park the funds, and then deposit the money into the solo 401k account, either pre-tax or Roth as applicable, by their business tax return date, including any timely filed extension. It's noteworthy that employer contributions, they're not reported on the W-2. Moreover, voluntary after-tax contributions, even though it is a type of employee contribution, per the W-2 instructions, it's optional to report on the W-2. So the individuals would only need to let the W-2 preparer know about the pre-tax or Roth employee contributions, also what they call elected deferrals. All right, next question is from Rob. I'm a bit confused on the employer contribution portion of the solo 401k. Is the employer contribution paid directly from the employer to the employee via check and supported by a 1099-R and no FICA tax is charged? The employer contribution is not in the employee W-2. Is that correct? So there's a couple of points to bring up in response to your good question, Rob. So number one, a solo 401k has the highest contribution limits for any defined contribution plan because it allows for both employee and employer contributions. Because in the words of the IRS, the self-employed person is both the employee and the employer. Now, the self-employed person's ability to contribute is based off of their self-employment compensation. You can't save more than you earn. So what your self-employment compensation is depends on how your self-employed business is taxed. For a business taxed as an S corporation, for example, your ability to contribute is based off of the W-2 wages that you receive from the S corp. Now, it's based off of box 1 of the W-2 plus any pre-tax elective deferrals not in box 1, but instead reported in box 12. In other words, you don't reduce it by payroll taxes. So the fact that FICA is being paid is not relevant to determining how much you can contribute. Now, the only type of contribution that's reported on the W-2 is the elective deferral, the employee contribution. For example, $23,500 is the limit for 2025 for those that are under age 50. Now, that employer contribution, it's not reported on the W-2, but you still have to have those W-2 wages to justify the contribution. So you can't contribute more than 25% of your W-2 wages to the solo 401k, assuming that all the contributions that you make to the solo 401k, whether employee, employer, and voluntary after tax, doesn't exceed the lesser of W-2 wages of the overall limit. So when you make those employer contributions, you got to have the W-2 wages to justify it. Those employer contributions are reported as tax deductible on the employer's tax return. And there would be no 1099-R issued, assuming that they were not being made as Roth contributions. So thanks to the Secure Act 2.0, it's now possible to make employer contributions as Roth contributions. Historically, they are always made as pre-tax contributions, so they're tax deductible. It reduces the taxable income on the employer's tax return. And so from the solopreneur's perspective, remember, they're the owner of the company. So they would receive a K-1 from the S corporation. So in other words, their share of the owner's income, which may be 100% if they're the 100% owner, that income share would be reduced by that employer contribution because that's going to be a tax deductible amount. That's how you reduce the taxes on the employer's tax return, the 1120S. So it's not reported on the 1099-R unless it's made as a Roth contribution, which in our experience is rare because even though Secure Act now allowed for employer contributions, Secure Act 2.0 now allowed for employer contributions to be made as Roth contributions. For our customers, they already had the ability to make mega backdoor Roth contributions. And so this was really a non-event based on experience and client feedback, because even though, of course, they can make those employer contributions as Roth contributions with our plan, most would just choose to skip it because it's going to be easier to hit the limit by simply making a mega backdoor Roth contribution, because you can contribute 100% of your wages, dollar for dollar, up to the limit. Whereas if you're making an employer contribution, as we just discussed, it's a percentage of your W-2 wages. So it's easier to hit the limit. So that's one reason they would skip. It's also simpler from a tax reporting perspective, because per the IRS guidance, if you're making an employer contribution as a Roth contribution, it still needs to be reported as tax deductible on the employer's return for the year for which the contribution is made. But since it's ultimately a Roth contribution, it still needs to be taxable to the employee for the year for which it's deposited. That's why I said if it's an employer contribution made as a Roth contribution, it still would need to be reported on a 1099-R, so you could report that as taxable income to the employee for the year for which it's being deposited. So it's more complicated from a reporting perspective. So that would be another reason that would drive clients to say, I'll just skip making the employer as a Roth, and I'll just go right to the after tax, then move the money from the after tax to the Roth, because that's more straightforward from a reporting perspective. Hopefully that helps, Rob. Thank you for bringing the good question. Our solo 401k plan is already established, but Schwab account's not open yet. Is it possible to claim the $500 on 2025 taxes? That's a good question from David. So if you set up the plan with us, then yes, because our plan automatically is drafted to be eligible for the tax credits, and your ability to claim those credits is not a function of whether the accounts were open by 2025. It's whether the plan was open, meaning the documents, which if you signed up with us, submitted the application and made payment, we create the plan documents within the same business day. It's also not a function of whether you make contributions, because remember, you can opt out of the default contribution percentage, which would allow you the option to just not make any contributions, and you would still be eligible to claim those credits. All right, next question from Asia. On my application, I didn't state 1/1/25, rather the date when I opened the solo 401k with Fidelity. Do I need to redo the application? Oftentimes, that's the date that is used as the effective date when you set up the solo 401k with Fidelity. So that should be acceptable then. You can proceed. Thank you for bringing the good question. Next question from Rajiv. Do I need to open separate accounts for my solo 401k, pre-tax, after-tax, and Roth conversion? The answer is yes, because even though it's one plan, the plan allows for different types of funds, pre-tax, Roth, and voluntary after-tax. Those different types of funds need to be kept in different accounts. So it's one plan, one fee, but different sub-accounts. You also need to have different sub-accounts if there's different participants, like say a husband and wife that are both working in the same business, both participating in the solo 401k. Great question from Rajiv. Next question from David. Mega backdoor question. Is there any wait time required from voluntary after-tax contribution till conversion to Roth IRA? No, there's not. And there's also no deadline either, David. So for example, if someone sets up a plan, if they sign up with us here in 2025, that'll lock in the ability to make all types of contributions for 2025 by their business tax return deadline, including any time they filed extension in 2026. So if their business is taxed as an S Corp, now they could make contributions by March 16th or September 15th if they file a timely extension for the 1120S. If their business is taxed as a sole proprietorship, now they can make contributions by April 15th or October 15th if they file a timely extension. That's the deadline to make the contribution. There is no deadline to convert to the Roth IRA. Now, most will want to convert as soon as possible because now they can start investing. Now they can start accruing gains on a potentially tax-free basis. So there's no deadline. There's no time to wait. There's also no deadline to convert. Now, when you do that conversion, you want to be sure to submit the form on our website. You can access it at mysolo401k.net/forms to give us the information that we need to be able to prepare the 1099-R. Because even though that first step, when you make the after-tax contribution, is not reportable, you don't need to report it on the personal tax return. It's not reportable on the business tax return. It's not reportable on the W-2 if your business is taxed as an S Corp. So the first step, the after-tax contribution, that's not reportable. But the second step, when you move the money from the after-tax to the Roth IRA, that is reportable by the plan. And we prepare that 1099-R for no additional charge. Customers just have to let us know about that transfer by submitting the form on our website, and then we can add their plan to the queue to prepare the 1099-R. Great question, David. Are there any banks like Schwab that are easier to work with for the Mega Backdoor Roth? Will you provide a link to this recording for me to review later? Well, you'll get a link automatically because you registered via the StreamYard. So in terms of brokerages, the top options are Fidelity and Schwab. So we've helped thousands of customers open up accounts there, and the ability to make Mega Backdoor Roth contributions is one of the top reasons that customers set up accounts. So they are great options based on our experience and client feedback. Now, as far as banks, if your goal is to invest in real estate, I agree. Many clients that do want to invest in alternative investments like real estate want to have access to a bank account. It could be at a local bank or a credit union. Based on experience, those are the best. And you could also have a brokerage account at Fidelity or Schwab. So and clients will sometimes move between the two, right? They might be investing in a mutual fund or an ETF between deals. And the reason that they'll want to have that bank account or that credit union account, again, local banks or credit unions are the best based on client experience and feedback. But the reason that a lot of customers do want to have that bank account is now they get access to certified bank checks. Now they get access to the ability to ACH funds easily in and out of the account. Now they get access to a debit card, things that can be helpful for those that are investing in those types of alternative investments. Do I need to tell you the amount of my after-tax contributions? I'm assuming you mean voluntary as opposed to excess. How are after-tax contributions reported if optional on the W-2? Well, you do need to have the W-2 wages to justify it. Let's make it easy. Let's assume the person is under 50 years of age. Let's assume that their business is taxed as an S Corp. They got at least $70,000 of W-2 wages from their business taxed as an S Corp. They don't make contributions to another plan. The only type of contribution that they want to contribute is a mega backdoor Roth contribution. So they just skip the employee. They skip the employer. They make the 100% of their wages as a voluntary after-tax contribution. So that's an after-tax contribution. It's not going to reduce the W-2 wages. So they're still going to be liable to report $70,000 of income under 1040 and pay the applicable income tax. And so it's not reportable. There's no need to report it. You're not reducing your taxable income. And you got those wages to justify the contribution. But what is reportable is the second step. So it's a two-step process when you make a mega backdoor Roth contribution. Step one is to deposit into a voluntary after-tax account because you're trying to take advantage of the higher voluntary after-tax contribution limits, which are 100% of your wages, dollar for dollar, up to the overall limit of $70,000, assuming you don't make any other contributions to the solo 401k. So the first step is put it into the after-tax so you get access to the higher limits. The second step is to move the funds over to a Roth account. So now that you got the potential for tax-free growth. So you need to have a plan like the one offered by my solo 401k Financial that allows for both steps. And of course, ours does. We were the first provider, the solo 401k provider, since 2013 to offer a plan that supported the mega backdoor Roth. Next question is from Sean. I already set up a solo 401k at Fidelity, pre-tax and Roth, with their basic plan document. But I learned they don't support mega backdoor Roth conversions. That's correct, Sean. They don't. So they were forced to offer Roth because now next year catch-up contributions for certain individuals who make over a certain amount. So if you're above a certain age and you make more than a certain amount, the catch-up contributions that you can make have to be made now as Roth contributions. So Fidelity is forced to allow for Roth contributions, but they're only allowing what they are forced to being forced to offer. In other words, they're only allowing for Roth employee contributions. They're not allowing for mega backdoor Roth contributions. They're not allowing for employer contributions to be made as Roth contributions. Fidelity is not allowing for in-plan Roth conversions, where you convert money that's already in your 401k from a pre-tax status to a Roth status. So the good news is that you can upgrade your plan from the basic plan at Fidelity to our plan, which will allow you to make mega backdoor Roth contributions. The good news is you got plenty of time because the voluntary after-tax contribution deadline for 2025 is the business tax return deadline, including any timely filed extension. And if you upgrade your plan, which you can upgrade your plan within the same business day, because it's just a matter of upgrading the documents. If we create the documents within the same business day, if you upgrade your plan by December 31st, now you'll be eligible to start claiming the tax credits when you file your 2025 tax return, $500 per year for 3 consecutive years, because those tax credits are not just limited to new plans. They're also available to pre-existing plans that are now upgraded to include the auto enrollment feature in the required notices that we automatically include when someone signs up for one of our plans. So you can just simply upgrade the plan, lock in the credits, take your time to open up new accounts. So to your question, you cannot use those existing accounts at Fidelity because those existing accounts from Fidelity's perspective are governed by their basic plan documents, which don't allow the features that you want. And their documents were cut out effectively and replaced with our documents. Now, the other good news is that Fidelity will open up accounts for people that bring their own plan documents. So we've helped thousands and thousands of customers open up accounts at Fidelity. That's the top brokerage option based on experience. So we'll help you open up new accounts at Fidelity for the restated plan. Then we'll help you transfer the cash and assets over from the pre-existing solo 401k accounts to the new accounts that are now governed by your advanced, fully featured solo 401k plan that does support the Mega Backdoor Roth, the one offered by my solo 401k Financial. Follow-up from Sean. Also, does the employee deferral funding and payment have to happen in 2025 to count in 2025? No, it does not. All types of contributions, whether employee, employer, voluntary after tax, the Mega Backdoor Roth, those can happen in 2026 by your business tax return deadline, including any timely filed extension. So as long as the plan is established by December 31st, 2025, which yours would be, of course, because you already set it up with Fidelity, then you can take your time to open up the accounts and make the contributions by your business tax return deadline, including any timely filed extension in 2026. And that's confirmed by IRS Publication 560. IRS Publication 560 is the landmark guidance for self-employed retirement plans like solo 401ks. And there's a chart on page 3 that makes crystal clear that as long as the plan is established by the end of the year, all types of contributions can happen next year by your business tax return deadline, including any timely filed extension. And this makes sense from a policy perspective because many self-employed individuals don't know how much they've made until after the end of the year, right? They might have a seasonal business where they're working all the way up to the end of the year and they're not exactly sure how much they made until after the end of the year. And of course, your ability to contribute is based off of your earned self-employment income. So it makes sense that the rules would give you time to determine how much you're going to contribute. When you say open the plan with us, does that mean open the account with you? That's a wonderful question, DT. Thank you so much for asking it. So it's important to understand that the plan is a legal entity. So it's the documents. So we are a IRS approved 401k plan document provider. What you can do with your plan is based on the documents. We are neutral as far as where the accounts are opened up at. So customers obtain the documents from us, then open up their accounts at the bank or brokerage of choice. We don't hold your money. We don't provide investment advice. We don't have access to your accounts. Now, that doesn't mean you're on your own. We're very hands-on with helping customers open up accounts at the bank or brokerage of choice, whether it's Fidelity, Schwab, a bank, a brokerage, just to name a few places. And so to meet the December 31st deadline, you just focus on the documents first. Then you can take your time to open up the accounts by your business tax return deadline, including any timely filed extension. So we've got a slide here that touches on that. It's a two-step process. Documents first, accounts later. So it's a holding account for the solo 401k. So we've talked about how Fidelity offers a basic solo 401k. So that means that Fidelity is providing the accounts and the plan. Their limited basic plan that doesn't support the Mega Backdoor Roth, doesn't support the tax credits, et cetera, et cetera. But Fidelity will offer holding accounts. In other words, brokerage accounts for people that bring their own plan documents. So you get the plan documents from us. As long as you get them by the end of the year, which will make it easy to do that because we prepare the documents within the same business day. Then in 2026, you can take your time to open up the holding accounts at Fidelity that are governed by our plan documents. All right, back to Rob. Follow up on the backdoor. If I were to contribute the mega backdoor from my employee wages, would I have to pay FICA taxes on the whole $46,500 backdoor contribution? In short, yes. Why? Because your ability to contribute is based off of your self-employment income. So if your business is taxed as an S corp, you've got to have earned self-employment income. What is earned self-employment income for a business taxed as an S corp? W-2 wages. So making 401k contributions doesn't reduce your payroll taxes. You still got to pay payroll taxes on your W-2 wages, regardless of whether it's a pre-tax or a Roth or an after-tax contribution. And so if you want to contribute $70,000 as a voluntary after-tax contribution, you need to have $70,000 of earned self-employment income. You can't save more than you earn. So if you want to contribute $46,500 as a voluntary after-tax contribution, you need to have at least $46,500 of W-2 wages. And that assumes you're not making any other contributions to the solo 401k, because the total amount of solo 401k contributions, whether employee, employer, or voluntary after-tax, can't exceed your W-2 wages. Great question from Rob. All right, next question from JR. With Fidelity brokerage, employer contributions towards solo 401k are required to be funded through the S Corp bank accounts. Fidelity was asking only for trustee bank information for EFT mapping and not the corporate bank information. Bit confused. Why is it the case? What are your thoughts and what needs to be communicated to Fidelity? So if you have the solo 401k plan documents from my solo 401k financial, and then you open the holding accounts for those plan documents at Fidelity, if you're making employer contributions, I'm assuming that those are pre-tax contributions. So whether you're making pre-tax employee or pre-tax employer, those go to the same account. From a solo 401k perspective, it doesn't matter where the funds are transferred from. What matters is that you have the income to justify the contribution. The contributions are within the contribution limits. They're made by the contribution deadline. They're reported as applicable on the business or personal tax return, et cetera, et cetera. Now, if Fidelity themselves, as the holding account provider, has requirements about how you can make electronic deposits to those accounts, obviously you got to live with those requirements, right? They are the financial institution, so they will have requirements on how you fund the account. But if they say, well, you can only fund it from a personal account, that's fine, because from a solo 401k perspective, you don't have to make contributions from a business account, regardless of whether it's an employee or an employer. So you can work with Fidelity's requirements. All right, great. Thanks, JR. Back to David. Can you clarify, did you say that employees' solo 401k catch-up contribution must go to the solo Roth 401k or can still go to the solo pre-tax 401k? Well, for 2025, yes, it can go to the pre-tax solo 401k. What I was referring to is the fact that starting next year in 2026, for certain solopreneurs, so you've only certain, not all, if you make more than a certain amount of W-2 wages and you're making a catch-up contribution, now the rules are going to force you to make that catch-up contribution as a Roth contribution. So mandatory Roth catch-up contributions is how it's referred to. But that's next year, not 2025. And I can tell by your question, you're talking about 2025, which makes sense because that's what folks are focused on now, is trying to lock in the ability to make 2025 contributions by their business tax return deadline, including any timely filed extension next year. So that brings us back to the deadline, right? That's a very hot topic this time of year. And there is still plenty of time, because all that you need to do to meet the deadline is establish the plan documents, which we make it easy to do that because we create the plan documents within the same business day when you sign up. So all you got to do is sign up, and it's a straightforward application, right? It's 10 simple questions. Just go to mysolo401k.net, click on open account, then click on get started under Solo 401k. That'll take you to the application. We're just gathering straightforward information like the name of your business, your address, how your business is taxed. You want to choose the name of the plan, which is just 2 words in the word trust. Could be any 2 words. It could be something that relates to your business name, or it could be something totally unrelated, right? Your favorite color, the street you grew up on. So, and then the word trust for a total of 3 words. Once you submit that application and make payment, we prepare the documents within the same day. An email goes out with a link to the document portal, a secure document portal where you can access the documents. You can take your time to return those completed and signed documents and let us know where you want to open up the accounts. So in that initial email, you'll get 3 links. You'll get a link to the document portal. You get a secure upload link where you can return the completed and signed pages. And then a 3rd link to what we call the next steps questionnaire, where you tell us where you want to open up the accounts. But as we've discussed, you don't have to open up the accounts by the end of the year. You just need to sign up by the end of the year. Then you can take your time in 2026 to open up the accounts, make the contributions, etc. These are the holding accounts for your plan that you have through My Solo 401k Financial. That's at the bank or brokerage of choice, right? Whether it's Fidelity, Schwab, local bank, credit union, down the line, just to give a few examples. Okay, last one. If the backdoor is partially paid by the employer side, it appears you do not pay FICA. And if it's paid on the W-2, you do pay FICA. So yes, that's not correct, because you have to have the W-2 wages to justify the contribution, regardless of whether the money is literally transferred from the business account or the personal account. So it's not correct. So you've got to have those W-2 wages to justify the contribution. Simple as that. And those W-2 wages are going to trigger the payroll taxes. There's no ifs, ands, or buts or way around it. Just to be clear, but that's a wonderful question. Rob, thank you. Next question from Sean. Back to Sean. Can you go over the mega backdoor Roth tax situation as a 3rd component after the employee deferral and employer match? Well, first of all, let me clarify, Sean. Matching contributions do not apply to a solo 401k. Matching contributions only apply to a full-time employer plan, like one that you would have in corporate America, a day job plan. Instead, for a solo 401k, you make profit-sharing contributions, also referred to as non-elective contributions, also referred to as employer contributions. So in other words, it's not dependent on whether you made an employee contribution. Many solo 401k account holders do not make employee contributions and only make employer. If it was a match, as the name applies, you got to have something to match. So your ability to make a matching contribution would be dependent on the employee contribution. So that's great that employer match don't apply to a solo 401k. So that's one important clarification. But to your point, that's a common use case where individuals want to diversify from a tax perspective. In other words, they may want to first maximize the pre-tax contribution and then make additional mega backdoor Roth contributions. So they make some pre-tax to reduce their taxable income now, then make additional Roth or mega backdoor Roth. So let's assume that the person's business is taxed as an S corporation. Let's assume that they're under 50 years of age. Let's assume that they don't make contributions to another plan like a day job plan. And let's assume they've got $100,000 of W-2 wages from their S corporation. So for 2025, as long as they sign up by the end of the year, they'll preserve the ability to open up holding accounts and make contributions by their business tax return deadline, including any timely filed extension in 2026. So this individual, because they're under 50 years of age, because they don't make contributions to another plan, can contribute 100% of their W-2 wages as an employee deferral, up to $23,500. On top of that, they can make an employer profit-sharing contribution of 25% of the W-2 wages. So that's another $25,000. Both of those contributions could be made as pre-tax contributions to reduce their taxable income now for 2025. So that brings us to a total of $48,500. Now, on top of that, because they set up a solo 401k plan with my solo 401k financial, they can also make a voluntary after-tax contribution. The voluntary after-tax contribution limit is 100% of their W-2 wages, dollar for dollar, up to the overall limit. But they also have to keep in mind the overall limit, which does provide that the sum of their employee, employer, and voluntary after-tax cannot exceed the overall limit. So that means that they would take that $70,000 and reduce it by the 25, reduce it by the 23.5. In other words, the 48.5 that they already contributed. So that means that if my math is right, they'd be able to contribute another $21,500 as a voluntary after-tax. So from an account perspective, they're going to have 3 accounts. One is a pre-tax account into which they deposited their pre-tax employee, the 23.5, their pre-tax employer, the 25,000, for a total of 48,500. Then they contribute the voluntary after-tax contribution, the 21.5, to the after-tax solo 401k account. Then they move it from the voluntary after-tax solo 401k account into the Roth account. Remember, that's a 2-step process. So that first step of making the voluntary after-tax contribution, that doesn't need to be reported on the personal tax return or the business tax return. It doesn't need to be reported on the W-2. But you do need to report the subsequent transfer from the voluntary after-tax account to the Roth solo 401k account. It needs to be reported by the plan. Now, it's not going to be taxable unless there might have been some small gains that accrued in the after-tax account, but most will want to move the money over right away so they can start investing via the Roth account so they can start accruing gains with that potential for tax-free growth. But it's still reportable, even though it's not taxable. We prepare the required reporting. Customers just need to let us know. Remember, again, we don't have access to your accounts. We're hands-on in helping you open up accounts, but we don't have access to your accounts. But we make it easy. You can submit a form on our website 24/7 at mysolo401k.net/forms to just let us know, okay, I moved over 21,500. Now we add your plan to the queue to prepare the 1099-R. We do that for no additional charge. Let's go back to Carl. Hypothetical example on voluntary after-tax contribution so I can understand better. Assume W-2 from an S-Corp is $50,000. Is possible contribution $23,500, $7,500 catch-up. That's a total of $31,000. There's no FICA on this $31,000, only on the remaining $19,000. No. Why? Making 401k contributions doesn't reduce your obligation to pay payroll. It only reduces box 1 of the W-2. Box 1 of the W-2 is what gets carried over to your 1040. So it does reduce how much you have to pay as income tax, but the other boxes of W-2 upon which you base your FICA tax are not reduced by making that employee contribution. Now, the employer contribution limit is $12,500. I agree. How much could I then contribute as a voluntary after-tax contribution? Well, you can't save more than you earn. The total amount of contributions, whether employee, catch-up, employer, cannot exceed the lesser of your W-2 wages of the overall limit. Here, your W-2 wages are below the overall limit. So all that's left to be able to contribute as a voluntary after-tax would be the difference between the total amount already contributed, the 43.5, up to 50,000. So if my math is right, that's another 6,500 that could be contributed as a voluntary after-tax, then move to the Roth solo 401k or Roth IRA. What if I have a W-2 for 2025 and 2026? I also have the LLC with my wife, no employees, which is going to be our main focus moving forward. Can I open the solo 401k? That's a great question from Emerson. It's a common use case because we got a lot of side hustlers, people that have a W-2 day job, and they also have a side business. So the fact that you have a W-2 day job, even if you participate in your W-2 employer sponsor plan, won't prevent you from setting up a solo 401k as long as you have separate self-employment activity with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any. All right, that's a great question from Emerson. So if this is helping you feel more confident about your retirement future, please like this video. Please like this video, whether you're on LinkedIn, whether you're on YouTube, whether you're on X, whether you're on Instagram. Liking this video is going to help us get the word out to other solopreneurs just like you. So it'd be greatly appreciated if you like the video. Please also subscribe as we have daily live webinars. Now, this time of year is the busiest time of year, so it's hard for us to do multiple daily live webinars like we do throughout the year, just with the holidays and the end of the year rush. So please, though, subscribe so that you can get notifications of when we go live. You can come and ask questions, et cetera, et cetera. All right, looks like that's taking us to the end. So thank you so much for the wonderful participation. We certainly appreciate it. That's it for today's Solo 401k session. Thank you so much for investing your time with us. Your time is valuable. Your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this Solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement. Final question here from Sean. Do you know if Schwab charges any fees for these accounts? So they do not charge any fees to open the accounts. There's no maintenance fees. They offer free online trading. All right, until next time, everyone, take care.